My typical clients all fit a similar profile: great income, good habits, doing all the things that we're told we're supposed to do. But I still get this question a lot: am I doing this in the right order? And here's the thing: most of the time, they're not. At least not before they start working with us. Not because they're making bad decisions, they're making all the right decisions. They're just making them in the wrong sequence. In that sequence, that order of operations, it's costing them hundreds of thousands of dollars over their career. So let me give you a real example. I had a client, we'll call him Mark. $240,000 of household income, 2 kids, early 40s. Mark was doing what most high earners do: maxing out his 401k, putting a little into a Roth IRA when he could, and anything left over went into a brokerage account. He felt really good about it, and honestly, on paper, it looked just fine. Most high earners follow what I'd call the default order. Step 1, max the 401k because, tax deduction today. Step 2, maybe fund a Roth IRA if you're still under the income limit. And then step 3, everything else goes into a taxable brokerage account. Last but not least, step 4, this is the one nobody thinks about: hope for the best. The problem with that order is it treats every dollar exactly the same. It assumes the tax deduction today is always worth more than flexibility later. And for high earners, I'm talking $175,000 to $300,000 and up in income, that assumption starts breaking down in ways most people never see. So let me walk you through what the right order actually looks like. The order of operations I walk my clients through has 5 layers, and the sequence matters more than any individual step by itself. Layer 1, and this is non-negotiable, is liquidity. Before you invest a single dollar beyond your 401k match, you need accessible cash and freedom. And I'm not talking about $5,000 sitting in the bank. For a high earner with a mortgage, kids, and a career that could take 6 months to replace, I want at least 3 to 4 months of expenses in a high yield savings account. Obviously, 6 months is much better. That's your foundation. Layer 2 is what I call the free money layer. If your employer matches 401k contributions, and most do under current law with all the changes that have happened over the past few years, you take every dollar of that match. That's a 50% or maybe even 100% immediate return on your money. There's no investment on earth that beats a guaranteed 100% return. So you contribute enough to get the full match and not a dollar more just yet. Layer 3. Now this is where most people's order goes wrong, is the Roth IRA. Now I know what you're thinking. Patrick, I make $250,000 a year. I can't contribute to a Roth IRA. And well, you may be right, at least not directly. But the backdoor Roth IRA has been around for years, and most high earners still aren't using it. Here's how it works. First, you contribute money to a traditional IRA. You convert those dollars from the traditional over to your Roth IRA. And now you've got your money in the Roth IRA. $7,500 per person or $15,000 for a married couple, for instance, in 2026. Growing completely tax-free for retirement. That's layer 3. Layer 4 is where you finally go back to your 401k and max it out. The full $24,500 or wherever the limit is for the year. But notice, we didn't start here. We built liquidity first, we took the free money second, and we funded tax-free growth third. Only now do we go all in on pre-tax or strike a balance between pre-tax and more Roth funds. Layer 5, the one most people skip entirely, is the taxable brokerage account. This is where the real flexibility lives. If you want to step back from work in your 50s instead of 65, you have limited options to touch your 401k without penalties until 59 and a half years old. But your brokerage account, that's available anytime. No penalties, no age restrictions, just capital gains tax where applicable. So why does this order actually matter? Let me use some real numbers for example. Let's go back to Mark. When he came to me, he had about $380,000 in his 401k, $30,000 in a Roth IRA, and around $60,000 in a taxable brokerage account. So roughly 80% of his retirement money was sitting in pre-tax dollars. That sounds fine until you run the math forward. If Mark keeps maxing that 401k for the next 20 years and the market does what it's historically done, he's looking at potentially more than $3 million in that account by the time he's 62 years old. That sounds great, but here's the catch. Every dollar that comes out of that account is taxed as ordinary income. At today's rates, $3 million in pre-tax could mean required minimum distributions, or RMDs, of over $100,000 a year by the time he's in his mid-70s, before he even chooses to take a single dollar out. And that forced income pushes him into higher tax brackets, potentially triggers Medicare surcharges, and makes his Social Security taxable. If Mark had instead followed this order, building his Roth and brokerage account alongside his 401k, he'd have what I call tax diversification. There's 3 buckets for this: pre-tax, tax-free, and taxable. And in retirement, he gets to decide which bucket to pull from based on what's most tax efficient in that calendar year. That's the game. It's not about having the biggest number, it's about having the most control over that number. Now, I want to be fair, this order isn't universal. There are absolutely cases where maxing the 401k first makes sense. If you live in a high tax state like California, New York, New Jersey, that 401k deduction is probably saving you both federal and state taxes. That can be 35, 40 cents on the dollar. In that case, you might front load the 401k a bit more aggressively. If you're planning to retire in a no tax state, selling the house in California and moving to Florida or Texas or another one, then maxing pre-tax now and paying lower rates later can work beautifully. And if you're within 10 years of retirement and you're genuinely behind on your funding, honestly, the 401k deduction at your peak earning years might be the right call. You need the growth and the tax break now versus later. The point isn't that one order is always right. The point is that the default order, 401k first, figure out the rest later, is wrong for more people than it's right for. And most high earners never stop to question it because everyone around them is just doing the same thing. So here's the reality. The difference between someone who follows the right order and someone who follows the default order isn't dramatic in year 1 or year 3, but over 20 or 25 years, the tax flexibility alone can be worth 6 figures, maybe even more. And beyond the math, and I say this to clients all the time, there's something genuinely valuable about knowing you have options, that you're not going to be 73 years old, forced to take distributions you don't need, paying taxes you could have avoided. That's what this order gives you: control. If this resonated, you'll probably like the video I did on the 3 questions that reveal if you're actually behind financially. I'll link that below. Make sure to subscribe and we'll catch you on the next one.